All right, so let's work this out here. You got $1,000 and it earns 20%. That means at the end of the year, you got $1,200, right? So then you take your $1,200 and you get 20% on that. You got $1,440. That's probably what you were thinking. And it works out that if you take 20% one year, 20% the next year, that equals 40. Let's divide it by 2 years. We have a 20% average per year. And the answer here is $1,440. Now, let's take another look. Let's say we had $1,000 and we earned 60%. Well, then we got $1,600. The next year, we actually have a loss. We lose 20%. $1,600 is down to $1,280. Well, now what is that? That's plus 60 minus 20. That's 40% divided by 2 years. That's also a 20% average rate of return per year, but we didn't get the same answer. We got $1,280. Well, what other possibilities could there be here? Let's say we had $1,000 and it was back in the 90s. I was in the financial service business then, and we had these tech funds, beautiful tech funds. Everything with .com was making money. And we had several of them that within a year actually gained 100%. So it doubled in 1 year to $2,000. But what happened after the tech bubble? Well, things went down. In many cases, we lost 60% on those funds after the crash within a year. So now if you've got $2,000 and it loses 60%, that's $1,200 you just lost. You're down to $800. But look at the average here. Look at what happens to the average. Plus 100 minus 60 equals 40. And if you divide that by 2 years, you still have a 20% average rate of return per year. You made 20% average per year on your money, but you're down from what you put in. Well, let's get a little more radical. Let's go to the real estate market in Florida back in 2006 and 7. Back then, you could have put $1,000 into a property. It would have made 140% in a year. Now you're up to $2,400. But then asset prices fell. The real estate market falls off. You're holding a mortgage much bigger than the value of the home. So you get out. You just let it wash. Your $2,400 loses 100% in a year. It's gone. It equals zero money that you have left in assets. But what's the math? Well, plus 140 minus 100% still equals 40%. And if you divide it by 2 years, it's a 20% average rate of return per year that you got on your money. You just happen to have $0 to show for it. Fact of the matter is, at the end of the day, all these answers are all correct. And that's the actual problem. Let's get this on a simpler, smaller version here, just to sort of get a better idea what's happening here. Let's say you made $100,000 already in the market and you had a 50% loss. So how much money would you have? You'd have $50,000. But now you want to get back to $100,000. What percentage increase are you going to need on that $50,000 in order to achieve $100,000 again? You're going to need 100% gain to come back. But yet, negative 50 plus 100% equals 50%. And if you divide that by 2 years, that's a 25% average rate per year. Yet here you are, you haven't made any money. You're back to $100,000 only, but you can proudly say at the next cocktail party that you made an average 25% per year rate of return. All right, I want to put it all together here and compare average rates of return versus compound interest in terms of what they mean to investing and monetary growth. I want to start with the S&P 500 as an index that we can look at because it's diversified. It's 11 sectors of the American economy. It represents a robust picture of the whole economy. If we go back on a graph here and we look at March of 09 at the bottom of the market, the S&P was down to 683, but it's grown to 1319 by February 2011. That's a 93% increase in your worth in the stock market from March of 2009 to 2011, or about 48% per year across that time. Now, Who wouldn't want to get that? Take 48% per year and put that to your rule of 72, and that is majorly significant. This is also why people are, once they're in and they see these market trends, it's very hard to get them to look at safety, no matter how high that market goes, no matter how likely the next fall off could be. People forget during the fall offs that the market was ever good. And during these high points, you can't convince anybody to do anything but just stay in the market because the growth is just great and it's a rocket ride. Now, you've often heard it said that the stock market is your best long-term investment. So let's actually look at the long term. Let's take this perspective of what's happened since March of 2009 and put it into the bigger picture of 11 years of performance in the S&P 500. And you can see at the tail end of this graph where this really begins to fit in, because all that's really happened with this great growth, this record-breaking growth since 2009, is we've barely gotten back to where the market was 11 years ago. So if in fact you're just trying to invest over the long run, this starts to take on a little different picture. And the fact of the matter is, over all of these years, the market's done basically 5 down years and 6 up years. And what that translates to is an average rate of return of 3.01%. Now, if you had an average rate of return of 3.01% and you invested $100,000, you should have $138,571 at this point after 11 years of that compounding growth. But your actual dollar return on $100,000 in this index over this 11-year period is not up, it's down. It's now down to 96,594 after 11 years of sitting in the market. The actual rate of return is negative 0.32 per year. And you can see here that we get that very easily by simply adding up February to February from 2000 to 2011, all the growth and contraction numbers. We put them all in a stack. We get 3306. We divide 3306 by the 11 years that it's taken place, and we wind up with 3.01%, which is the average rate of return. Yet the S&P in 2000 was at 1366, and the same date, 2011, it's at 1319. You haven't even made any money, but you got an average rate of return of 3.01% per year. And the moral of the story is, average rates of return in anything that can decrease in value are a lie. They're a worthless statistic. They don't show anything. And you can't use an average rate of return to guess, to think, to try to calculate where you're going to be in an investment if the potential for that investment can decrease in value. That's not to say that there aren't correct ways of measuring historical market performance, but average rates of return, as we're showing it here, is not one of them. The historical average, it's a worthless measure.